Well, thank you very much, David McMillan, for being on the show today. Really appreciate your time. Before we jump in, can you share a little bit about who you are and a bit about your business, please?
Sure. Thanks for having me. David McMillan's my name, Director of Performance Property. Performance Property has been in operation since 2013. We help investors invest in the property market. More specifically, we build property portfolios, and that involves buying property, managing property, giving advice around, how to build the property portfolio. We syndicate property. We buy it nationally. We buy all property types, depending on what's in the best interest of the investor.
Very good. I'd love to start firstly, please, by, I guess, talking about the property market more broadly. Like our economy's in this really unusual state of play. We've got stubbornly high inflation. We've got really high interest rates. Confusingly, we've still got really, really good consumer spending levels, perhaps too good. How do you see this environment impacting property prices?
Well, I think at a fundamental level, and this is what we talk to clients about, is the property market is not a market; it's many different markets around the country. And when we talk about different markets, we're talking about cities and towns, and we research every town with a population greater than 50,000 people. In those towns, they all have different stories. So, if I was to answer that question in general, the high interest rates are, holding back growth in some areas and causing other areas to fall. But, if you go a couple of layers deeper, and we talked about specific markets, there's specific markets that are doing incredibly well, primarily because of the essence of economics, which is demand exceeds supply. So when demand exceeds supply, prices rise. And in some markets, you have demand aggressively exceeding supply, and markets are rising faster. And that's certainly playing out even in the face of higher interest rate environments, or what interest rate environment, an interest rate environment which is higher than normal for most people, especially if you're an investor in the last 10 years.
Yeah, thank you. I think that makes me think about the expression, something that we say to a lot of our members, which is this idea of you should think about property investing as borderless. You shouldn't be looking at the suburbs or the suburbs that are just around the corner, or indeed the suburbs in your state, because as you pointed out, you've got a lot of property markets across Australia that are all doing different things at different times. Can I ask you, what do you feel, or where do you feel presents, which areas do you feel present the best property investment options right now?
Well, at a theoretical level, it's always the same answer, which is where you have demand exceeding supply aggressively and where there's affordability. Where those conditions exist right now is Perth, and that's probably the most dominant place where we're investing. But some other areas in Southeast Queensland also show some value at the moment. And they're the primary markets that we're participating in to get the greatest return in the shortest amount of time, right? And that's typically our trading strategy, where we're trying to buy a property for 750,000 and, look to sell it for 1.25 to 1.5 million in a medium-term framework, 4 to 7 year time. So, to answer that question well, you also need to start with, well, what is the strategy, right? So is the strategy to buy, hold, and never sell? If the strategy is to buy, hold, and never sell, then borderless investing becomes less relevant, because if you're in a quality market, you could buy, hold, never sell, and achieve great long-term growth, right? The issue with that is people run out of borrowing capacity. And then if you've run out of borrowing capacity and all your money's allocated to a market that's going sideways, then that's a big problem, because you're just going to have a negative geared strategy. You're going to be paying, the money coming in is going to be less than the money going out. It's going to be costing you money. You're going to be looking at the asset value growth, and there isn't going to be any. So, the strategy of finding markets that are very affordable and where demand exceeds supply is a good one, because whether it's a trading strategy, that is, you're buying and selling for a specific time frame, or it's a long-term strategy, you're always going to make more money, right? So borderless investing for us has been one of the reasons why the business is so successful, because we've been able to take our clients outside of whatever market they're in and take them to a market where they're going to get the best growth.
Yeah, thank you. I can, I can speak firsthand to this, because we have had this experience, you and I together. think about a few years ago, 2021 or thereafter, early 2021, when I was looking to purchase an investment property, and we had a conversation, and you said, look, the right place to buy is Perth. You gave me the reasons for it. I said, yep, all good, let's get it done. And that's done remarkably well. Now, at the time, I was also considering another option, which was in Victoria. And, you know, I'm incredibly grateful for taking your advice, mate, because, you know, one has done remarkably well over the last 3 years with still a lot of upside. And at the same time frame, Melbourne and Victoria more broadly has tracked sideways.
And I think, like, when I first started out, I started out as a Melbourne buyer agent. And I quickly learned within 12 months the limitations around having one market, because I was studying all the other markets around the country, looking at what they were doing at the time, and then realized that if you want to be a serious property investor and make the most of your borrowing capacity and capital, you needed to have a national perspective and be able to position your investment that was going to get the best risk-adjusted return. And that sometimes is in Melbourne, of course, for those investors who are in Melbourne, but you know, probably that's only the case 2 years out of 10.
Sure.
Which
I
is
think to myself, reflecting on the experience that I've had working with buyers agents, and in particular when our relationship started, which was many years ago, sitting with a lot of buyers agents, and sitting with people in particular who only purchased in Melbourne, or I really focus on the Carlton, North Melbourne, Essendon type area, for example. And and as I had those discussions, it really struck me that there's so much value in working with a buyer's agent, but with respect, I really do question the value of working with a buyer's agent or maximizing your value if they specialize on, you know, just the Mornington Peninsula. It might be different if you're trying to buy a home, but if you're trying to buy an investment property, you need a bigger lens, right?
Yeah, and that's we've got two brands. One's a home buying business where local area speciality is the value proposition, and then the investment business, you know, the value proposition is getting the strategy right, then making sure that you can acquire in that location that requires you to acquire property in it because you have massive affordability, massive demand, you know, and it's actually a different value proposition than buyer's advocacy. Buyer's advocacy is part of a quality investment strategy, but it's not all of it.
It's reasonable to think that interest rates are going to decline over the medium term. I feel ridiculous saying that because 12 months ago, I feel like I would have been saying it's a given that interest rates are going to decline over the short term. So now I've had to, you know, water down those comments a lot. But if we are looking at interest rates realistically declining over the medium term, how is that likely to impact asset prices?
Well, I mean, if you look back through history, every time interest rates come off, asset prices go up. There's just more money in the economy when interest rates come off. So what we're forecasting in our models is a 100 basis point cut over the sort of shortish to medium term, and what that is going to mean depends on the geographic locality in the country, as I mentioned before. But for areas that are completely unaffordable, like Perth, for like Sydney, right? I don't think the interest rate cuts are going to do too much because the market is so unaffordable. It's not funny. But for those markets that are very affordable, like Perth, it probably means the rate of growth is only going to speed up. And for a market like Melbourne, for instance, it might mean that the sentiment, the real negative sentiment that's in the Melbourne market may start to improve and become, you know, it might revert from being pessimistic to optimistic, and that might enable Melbourne to start growing again. So at a macro level, falling interest rates is a good thing. But you still got to understand what's going on at that town level to ascertain what's going to happen in your particular area of interest. Does that answer the question?
It does.
Yeah,
it does.
Yeah.
I think it dovetails into the idea that I'd be really keen to get your thoughts on this. I've spoken with a lot of people, both members and friends and family, who have sort of loosely got the idea that we're just going to wait out this interest rate cycle. We're going to wait till we start seeing some clear cuts and there's a lot more confidence, and then at that point where we're going to get started with the investment or to upgrade the home or whatever it would be. Yeah, in my heart of hearts, I've got a little bit of hesitation about that strategy, but I'd love to get your lens on it. What do you think?
Well, I think that the power of supply and demand um, is greater than any other influence, right? So let's take Perth, for example. I think Perth this year will do a 30% year, right? And last year probably did 15, and the year before that probably did 10. Think about what's happened in the last 36 months is interest rates have sped up at the fastest pace in history, right? So what that tells you very clearly is, okay, the market in Perth has gone up, significantly over the same period that interest rates have risen significantly in terms of speed. So that tells me very clearly that supply and demand and supply is more potent than interest rate rises. So when you think about that, interest rates are a close secondary factor to demand and supply. There are always opportunities. And if you're an investor, you should be thinking about, well, if I have the borrowing capacity, if I have the cash and I want to invest in property, typically there's always a really good market to invest in that year. Not always, like not 10 years out of 10 years, but certainly in my experience, 9 years out of 10 years, there's always been a market to take that borrowing capacity and capital to. And you can't control interest rates. So if you're waiting for interest rates to come off, you could be waiting another 3 years. In theory, you could be waiting another 3 years, and all of a sudden a market might have done 50% in that period of time, and that could have set you up to make a better, more positive decision in the future. So I would argue quite strongly that in fact, the market is waiting for all the green lights to line up before people invest. Demand exceeds supply, interest rates coming off, positive economic story, et cetera, and then they'll invest. But of course, what typically happens is the market's already gone so far past where it was prior to those green lights lining up that they've missed out on hundreds of thousands of dollars of gains, right? So I think you need to get the strategy right first. Then once you got the strategy right, go to the right market, and whatever happens with interest rates will either produce tailwinds or headwinds. Either way, if the strategy and the market are right, you're going to have a positive outcome, and you can't control interest rates. So in fact, I would go as far as to say I like investing when interest rates are uncertain and rising a little bit because there's less competition. And you're positioning your capital in a market, and as soon as interest rates go the other way, that's when you make all your money, because everyone else is in, and they're pushing up your asset prices, which takes that takes a while to get your head around. And certainly, I think my first investment phase was me learning that. First, all in my 20s, I was thinking that way, and then my mind really shifted once I was on the wrong side of it too many times.
Yeah, I can appreciate that. I think to myself about the time frame, like just the sheer time that it takes to actually execute on a strategy. Like the idea of saying, okay, it's time to buy the investment property, let alone it's time to upgrade the home or whatever it would be. And if you resolve to do that today, for instance, if 6 to 9 months has gone by and you've executed on that strategy, you've probably done that a lot faster than most, right? So if we are waiting for this event, if waiting for those green lights to line up, so to speak, it's you'd rather be on the start line, sort of waiting for the green light, being totally ready and being invested. Versus the lights go green, everyone's racing, and you're still getting everything organized.
You're there, mate. We just had a dropout. Sorry.
All right.
That was my internet. It just sort of blacked out for a while. Wow.
Oh, good, mate. I might do that one again if it's okay, and I'll just
edit it.
I also think to myself about just the sheer time that it takes in order to execute on a strategy, like on a property purchase. In my experience, for people that resolve to either upgrade the home or buy an investment property, from that day, if in 6 to 9 months you've executed on that strategy, you've probably done it faster than most. And thinking about waiting for something to happen, I'm thinking to myself that, and I've always felt that you may very well be better being at the start line, already invested, waiting for the lights to go green, than seeing the lights go green and everyone races off, and you're still trying to get your ducks lined up and get finance organized and get all those sorts of things that you need to actually get started with your strategy, right?
Yeah, and I think it's a good analogy. And I think the other thing to consider is if you invested now, whilst there is some interest rate uncertainty or interest rates aren't coming off, what's the downside? Okay, what's the downside of doing that? The downside of doing that is prices might fall because of interest rates. Okay, but what's going on with supply, demand, affordability in that market, right? So if you've got cheap prices and you've got demand exceeding supply to such an extent that rents have doubled and you're seeing some modest price growth, the opportunity for price falls is that the probability is so low that you go, okay, well, if the probability is so low in a rising interest rate environment, the prices will fall. Imagine what it's going to do when all the lights turn green. It is going to go up so fast. And I think that's an investor maturity thing. Like once you've spent enough time thinking about it and you've read enough books and you just at a certain level where you have enough confidence in the cause and effect relationships of how investing works, then you kind of have the confidence to do it. And then once you see the results of that, then
Reaffirms that.
well, it reaffirms that, and then you'll never change. You'll always go, well, we are investing in these uncertain times because we understand the cause and effect relationships of what we're doing, right? Yeah. And it's when you don't have confidence in those cause and effect relationships and you're running more off sentiment and popular, belief and media and all that stuff, that's when you're at most risk as an investor because you're not grounded in those cause and effect relationships. So the sooner you can work out what is true, the better. And that's one of the reasons why you go to an advisor, because a good advisor should be able to give you confidence to do what needs to be done. And one of the reasons why you're having this talk with me is to try and educate people to that effect. So, I know that you've invested personally, and as have I, and invested quite heavily personally, because what we both know is interest rates will at some point come off. And when they do, we won't have to do anything. We'll just sit there and watch the growth in the market with great interest rather than anxiety.
Yeah. Really well said, mate. If I may, the last thing that I'd love to reference is that I say really confidently that when it comes to research, I think you guys are best in class. The research that you guys are releasing on a monthly basis in markets across the country is both brilliant and also really enticing. So if you want to subscribe to that research and take stock of where things are market-wise, what can people do?
Well, they can reach out to you, and as you know, that we distribute it to you, so then you can distribute it to them, and because they're valued clients of yours and you're a valued relationship to us. And hopefully that gets their level of understanding of how the market works one step higher. And then, if that leads to a positive outcome for them, that's what we're trying to achieve.
Thank you very much, mate. I'm really appreciative of your time today, as always. Thank you for your insights and look forward to chatting to you more.
Awesome. Thanks, mate.
Thanks, mate.